So you've started investing and you want to build a really strong stock portfolio. Well, today I'm going to share with you some tips on just how to do that. How's it going, guys? Ryan here with another investing video, and today we're talking about how you can build a solid stock portfolio, and in particular one that's strong and going to last the test of time. But before we get into that, guys, if you do enjoy this video, please remember to give me a thumbs up. It helps me out so much, and subscribe for more content like this. We talk about stocks, wealth management, investing, long-term and trading, all that sort of awesome stuff, guys. So please remember to stick with the channel by hitting that subscribe button, and leave a comment down below on some of your stock tips for creating a strong investment portfolio. So guys, without further ado, let's get straight into it. And as I mentioned, we're talking about how to build a strong stock portfolio. And today I'm going to share with you 4 key ways on how to do that. And I've developed a strong stock portfolio, in particular over the past 1.5 years, using these features. So, number 1, solid fundamentals. This is something you have heard me harp on about so many times before. Solid fundamentals is absolutely key. You're looking for those important things such as low capex, low opex, incredibly good management, no to little debt, cash flow if possible, all these sorts of good things. The more boxes that you can tick when you're choosing a share, the better. And if you put a set of criteria together that each stock has to meet before you pull the trigger to invest, even better, because then you're increasing your chances of success by making sure you're only picking those stocks with the best potential for growth and for future profits. That is the effective key to a successful company. Strong fundamentals. So, number 2, and this is quite an interesting one, and it's something I haven't really spoken about too much, and effectively what it is getting set early. Now, what does that mean? Getting set early effectively means you need to be in a stock before the herd or the crowd knows about it. So if you're seeing a stock pop up on social media, this article's being written on it, it's on the news, you're too late. If you're getting in the microcap space especially, you are too late by that point. What you need to do is dedicate some time and energy into researching stocks that have really, really good potential. Once again, those solid fundamentals you're looking for can be used as your criteria to scan through stocks. There are also plenty of people on social media who consistently post about, the new stocks they're investing in, stocks that are of interest, people sharing articles, that sort of stuff. You can gather information. I would tend to point you towards investor interviews with the directors or the CEOs or some level of management, and they'll give you a really good insight onto the company itself. You can see lots of these sort of interviews on YouTube and Twitter, those sorts of places. But what you want to do is find these really good companies and get set early. You want to be in before the crowd. Not only will the price be incredibly cheap, the upside is absolutely enormous. This is where you see people making those 500%, 1000%, 1500% profits on their investments because they're getting in early before the herd knows about it. This is critical if you want to make real wealth and make really big gains. You only need one of these type of investments with a decent bit of capital invested into it, and it can change your life completely due to the fact that the absolutely insane growth that can occur, and from a long-term perspective, if you hold it long enough, you could get to dividends and that sort of thing. Make sure they have the solid fundamentals, and make sure you're getting set early and doing your research to make sure that you can get in there before the herd knows about it. Now, the third tip that I'll give you guys today, spread your risk but not too much. Now, spreading your risk is obviously good because you don't want to put all your eggs in one basket. For all you know, even the best company that you think you've invested in could go downhill. And the issue with that is if you've injected all your capital into one company and it starts to go down, you're losing money. There's nothing that's offsetting it. You've got no other opportunities on the radar. All your money's injected in there. So what you want to do is spread your risk. But as I mentioned, not too much. You want to only have a select few companies. I'd recommend at an absolute maximum, when you've been doing it for a few years, 5 to 10 max. You do not want to be exceeding that point. And effectively, you want to be getting into these stocks that, once again, meet all these successful fundamental criteria: low capex, low opex, good management, no debt, cash on hand, all that sort of stuff. You want to get in there, get set early, accumulate the shares, and you want to do it over time. And I've actually just touched on tip 4 there, which is accumulation, but we'll get back to that. You want to make sure you're invested and spreading your risk amongst different shares. Now, that doesn't necessarily mean you have to stray away into different sectors, for instance. So your forte may be in mining, such as mine, so you can stick to that sector. Just spread your risk amongst maybe different minerals. So you might be invested in gold and you might be invested in iron ore, for instance. These are the sort of things that you can look for because you can apply the same principles to each. A gold stock operates in the exact same way as an iron ore stock, in the exact same way as a lithium stock. It all comes back to the price of the commodity, the demand, the cost to get it out the ground, the cost to process it, transport. All those same factors still apply to those stocks. So what you want to do is pick your sector, whatever the sector is that you're good at, or you can expand into others if you want. Pick your sector, pick a few good stocks and spread your risk across those. Now, as I mentioned, tip number 4, accumulation. What you want to do, you don't want to just be constantly chucking your money into all these random shares. You've picked these good companies, so accumulate shares in each of them over time. Or what you can do is, let's say you've only just started getting into investing, you're in your first year, obviously you probably don't have that much capital. Accumulate over time. So let's say you've got 3 companies which you think are going to do really good in the future. You're looking long term, 5 to 10 years, that sort of perspective. What you want to do is effectively accumulate them over time. Don't inject your capital all into just one of them. Inject, let's say you have $15,000, for instance, decent amount of money. Put 5 grand in each of them. Spread your risk across each of those shares, but they still all meet that criteria. And then over time, accumulate these shares. So for instance, let's say 2 of the shares have shot up and one of them hasn't done too much at all, but it's going to shoot up. You've been paid your monthly or weekly or, fortnightly income. Inject your money into that lower stock. Then that one goes up and the others pull back a bit. Then the next time you get paid, you accumulate some of those others. But the point is, you're accumulating those shares which are good. You're not out there looking for potential new opportunities unless they really present themselves or you've done your research on them. You've got something good going here for you. You've gotten set early. You've got your risk spread against 3, 4, 5, whatever it is, good stocks. Accumulate these stocks. They're going to continue to grow over time and continue to generate you wealth. You don't need to be adding anything else into the mix if what's currently going is good for you. And conversely, if one of those stocks actually turns out not to be as successful as you suspected, and instead it's going the opposite direction and you're losing money, cut it and inject that cash into the companies that are doing well. You want to water your flowers and not the weeds. So cut those crap ones, put it into the stocks which will do well. So guys, I hope those tips did help you out for when you're looking at putting together a strong long-term investment portfolio. If they did, please remember to give me a like. Helps me out so much, guys, and subscribe for more content like this. And as I mentioned before, guys, leave down below your thoughts on some tips that have helped you establish a good long-term strong portfolio. So with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.